I'm Bob Goulder, a contributing editor with Tax Notes. Thank you for joining us today. We are going to continue our webinar series on what is really a very timely topic: how government should respond to fiscal challenges and spur economic recovery post-COVID. Now, this is the third episode in this series. If you missed any of the previous segments, you can find them on the Tax Notes YouTube channel, and they're really worth watching, so I encourage you to do so. I should mention that all of the materials in this series have been compiled by the International Tax and Investment Center, the ITIC, an independent research and education organization. Since 1993, the ITIC has been focusing on tax and investment reforms in the developing economies. Now, the papers that make up this series, they share one common element, and they're forward-looking. They offer perspective on what kind of tax policies government should pursue once we enter this post-pandemic phase. And goodness, hopefully we get there sooner rather than later. But we're going to get there eventually, and governments are going to need to think about something, because there's a big challenge in this context. How do governments address their very reasonable and understandable needs for more revenue while avoiding the chilling effect? Because you don't want to dissuade investment and economic growth. Now, you might think this is the same predicament governments always find themselves in. You know, they need tax revenue, but if you tax too much, turn the screw too tightly, then you have a chilling effect. But everything has changed with COVID, because the spending obligations have just gone through the roof, and on the other side, the tax receipts are way down because economic activity, the volume is reduced. So it's sort of a fiscal double whammy, and addressing it is going to take a lot of balance on the part of government policymakers and tax administrators. Now, my publication, Tax Notes International, is delighted to be publishing all of the papers in this series. So if you're a reader, keep your eyes peeled. They'll be appearing in the publication through the end of January. Today's discussion is based on an article that ran September 21st in Tax Notes International, and it's titled "Global Tax Policy Challenges After COVID-19, Transfer Pricing and Withholding Tax Aspects." Now, these topics necessarily implicate the role of large multinational corporations, often with very sophisticated cross-border supply chains. And it's an area that attracts a lot of attention. So I'm sure there's going to be a lot for us to unpack. To that end, I would like to welcome our guests for today's webinar, the two authors of this piece. They are Hafiz Choudhury, a principal with the M Group, an international consultancy based in Washington, D.C. Mr. Choudhury is also a senior technical advisor with the ITIC and a general editor of the United Nations Transfer Pricing Manual. His co-author joins us from London, England. He is Peter Hann, a senior consultant with the M Group. Gentlemen, thank you very much for taking the time to join us today. Appreciate you having us with us. And let's get started, because there's going to be a lot of material here. Now, Hafiz, why don't we begin with your presentation first?
Thank you, Bob. And good morning, good afternoon, good evening, which is, I understand, the normal salutation these days of the coronavirus. So we have here the start of the title is what Bob said, and if you are wondering why it's saying aspects, because this is part of a series of papers addressing that double whammy. So next slide, please. So this is exactly what Bob started the conversation with, that governments are focusing on, on this challenge of increased spending, and having to borrow to meet this, but that money has to be paid back sometime. And this is a particularly acute problem in developing countries. This is partly because developing countries, A, have less of a cushion to work with in terms of reserves and so forth, but B, unlike a lot of OECD countries, and I know the US is an outlier in this, that's the only OECD nation without a VAT, but the majority of OECD countries, and really the majority of countries in the world, have some kind of destination-based consumption tax, and the direction that governments have been pushed, especially in emerging and frontier markets, which is what this paper is all about, has been to move away from reliance on a corporate income tax and consequent high rates of corporate income tax and vulnerability to tax expenditures towards more of a consumption tax driven revenue basis. And as you can all guess, in this current situation, there's not a lot of consumption, especially in the second quarter. We have seen in country after country consumption tax collections at a very low level. So this is a real challenge, and how economies are to be revived after the crisis is going to be very different. And there's been a fair amount of literature already on the uneven nature of any potential recovery, where basically the wealthier and the better off will come out of the crisis richer and faster, whereas the poor will take longer. And that, in a way, it seems to be the writing on the wall. I'm not a macroeconomist, but I work with a lot of those people, and that's what I hear. The other challenge, and this is, again, I'm assuming that the majority of people on the call are from OECD countries. There are these broader challenges that developing countries face, which are, shall we say, environmental or structural, which is this outflow of capital that has taken place, especially in portfolio capital, where countries that have relied, who have liberalized and have opened up to some extent, have had money taken out in this situation, where particularly companies have taken money to protect their core operations. So those environmental challenges, the pressure to collect more tax, and the ongoing challenges of a low tax to GDP ratio and very limited administrative capacity are the overall context within which this crisis takes place. Next slide, please. So turning to, I think, the people who are on this call, what are we concerned about? This is, I'm staying outside of the fiscal environment for 1 minute, is stepping out and just looking at it from the perspective of our multinational clients. And M Group, my firm, does work around tax strategy for multinationals as well. So we have some sense of that, of what is going on there. What the crisis has done for a lot of companies is expose the difficulties of supply chains, security, diversification, and then broader trends come into play there as well. A lot of companies who were sourcing products, particularly goods, from China, have been affected by the US-China trade relationship and the dynamics of that. So they were already looking at potential diversification and security of supply chains. We've seen in the popular press all the issues around the problems of relying on essentially China for so much of textiles, for example, and the consequent shortages of PPE and so forth. So all of that, just from a corporate standpoint, has led, and I certainly know of clients who are considering an overall restructuring of their supply chain, bringing some things nearer home, even if the cost is higher, to serve customers better, to have security of supply chains. So what we are trying to put forward for consideration for people in this series of papers, which were originally intended for ITIC sponsor group, which are basically the large multinationals, was, when you do that, look at the broader policy trends, what's going on over there, and be aware of what environmental pressures policymakers in developing countries are also facing. And in that viewpoint, I would suggest this particular paper from UNCTAD, the United Nations Conference on Trade and Development, called Tackling Illicit Flows for Sustainable Development in Africa. And this is a broad trend line that has come about from the CSO community, the advocates for developing countries, very well-meaning advocates, I would say, which have posited the use of multinational structures, for example, to avoid taxes in developing countries, and whether those are actually whether something that is legal tax avoidance is an illicit financial flow or not is a philosophical argument, I suppose. But what I'm presenting to everybody on the call today is that this is a real challenge, and the figures that are bandied about, that Africa is losing between 90 and 100 billion dollars a year in tax revenue from illicit financial flows, is a number that is real money in anybody's book. Next slide, please. So why I've raised this is the potential challenge that companies face, and that's where where we move into the technical side of this, into transfer pricing. As you are probably aware, there is significant guidance out there already in the OECD guidelines and in the UN manual. There will be, and I'll just use this as a plug for the upcoming third edition of the UN manual that we are just starting on. The chapters have been approved. There is further additions to the guidance on business restructurings. So as those restructurings happen, my first kind of takeaway for people to think about here is to look at that guidance, especially the guidance that is coming out in the UN manual. So in that, the manual in particular stresses the importance of the delineation of transactions and how to do the comparability analysis. And in that particular area, I would point out two things. One that has been discussed more on the UN side of the guidance market, shall we say, around location-specific advantages, which is a concept that was brought about by India, but has been adopted by a number of countries in their administrative practices and sometimes even in their national guidelines. The other one is around market-facing allocations. And I'll just use this as a plug to, we don't want to get too bogged down in BEPS 2.0 and the Pillar 1, Pillar 2 stuff, but we will cover it slightly in the context of developing countries. But again, what I would offer as a takeaway for companies and practitioners advising multinationals is, given that market-facing allocations are already being discussed in your restructuring plans, when you or your clients are looking at restructuring, one idea to consider could be how to reallocate supply chains to allocate appropriate value to market with large market jurisdictions. So with that, can we move to the next slide, and Peter will take over on the more detailed technical points.
Okay. Right, thank you. What links to the business restructurings is that as supply chains may be moving around restructuring, the question of where are intangibles, and because of the recent guidance from the OECD in the BEPS project and guidance from the UN, a lot of countries, even fairly small countries without many resources, will be very much more aware of the need to look at intangibles and make sure that for example, intangibles aren't being undervalued deliberately. Now, the definition of intangibles, I think, has been widened quite a lot, or at least countries will see the definition as being much wider as a result of recent developments. It's no longer just something that's patented or something like that. There are whole new possibilities for looking at something as an intangible asset, which they might want to define and look at more. Identification of intangibles is therefore going to be an important aspect. And there's also a lot more going on with regard to valuation of intangibles, a lot more information around in the guidance, a lot more help for a resource-strapped tax administration to look at intangibles and say, is this valuation correct or not? In the article, we mentioned marketing intangibles, which are perhaps a case in point that especially a small country that is looking at a large multinational concern may be thinking how much of their local brand was actually built up in this country. How can we look at that? Can we look at the relative marketing expenses in our location? And that's quite an area for, I would say, potential disputes as well as anything else, and indeed has been in the past. But it's something that multinational organisations will have to be looking out for, that they could be told that by the local tax administration that in fact they've built up a marketing intangible in the local country, which they had been treated perhaps as not there, or vice versa, that they are using a marketing intangible from elsewhere in the local jurisdiction. So there's a whole lot of scope for a lot of potential disputes with tax administrations on that point. But again, we bear in mind what we've said before, that for example, a developing country is having a cost-benefit exercise here if it has limited resources, and how much does it want to go through potential litigation on points like this? What would be the tax benefit? And in a lot of cases, it may not be worth their while to pursue arguments on valuation of intangibles, which also is resource consuming from their point of view. So, and also there's the argument also mentioned before about possible discouragement of foreign investment if the local tax administration gets a bit too fond of litigation in its understandable desperation to collect more tax after the crisis. So that there are issues there that will need to be borne in mind. There is, well, we had a question, a written question in relation, I think, to the use of the profit split method. One which we can perhaps come on to a bit later, but one point on that is that a local tax administration could possibly say, look, you've got intangibles here. This is a profit split situation where the multinational doesn't agree. So those are just things to bear in mind. We'll go back to that question a bit later. I'll go on to financial transactions and just mention the OECD, of course, has brought out a lot of stuff in respect of financial transactions, correctly delineating the considerations for risk, etc. Very familiar BEPS type stuff, but it's now all there and it's available to tax administrations. And there is UN guidance coming into their practical transfer pricing manual, and it is accessible now on the internet, UN. So that's something that already developing countries will be aware of and could be applying. And the restructuring of supply chains will also imply restructuring of financial transactions. So there'll be plenty of opportunities for tax administrations to get involved in applying this new guidance. And it's something that multinationals will have to look out for. I'll move on quickly. Transfer pricing audits. Really what is in our article, I suppose, is the standard common sense stuff that a small country, say, that doesn't have many resources, will need to use those resources as efficiently as possible. It's going to be doing some sort of risk-based selection for audit. Inevitably, one aspect of that will be the size of the company involved, the size of the transactions involved. So it will be looking at those, and it will also look at certain types of transactions seen as high risk, transactions involving a low tax jurisdiction, or possibly transactions in certain industries, finance, possibly pharmaceuticals, whatever they may see as high risk at that particular time. So that's another thing to look out for. Now, there is this question of finding comparable companies, which has been an issue for developing countries, much discussed during the BEPS process. And we mentioned there is the PCT platform for collaboration on tax has brought out the toolkit on comparable transactions, which again is mentioning where there aren't comparable transactions, maybe the tax administration can look at safe harbors as one way of saving themselves and perhaps the taxpayer compliance costs, although the taxpayer could then have problems in the other jurisdiction involved in the transaction. And again, the PCT toolkit does mention the profit split again. Try looking at a profit split where you don't need comparable transactions, although it does link that strictly to highly integrated organisations, or where both parties are using unique intangibles. So it's not saying just use the profit split whenever you like to avoid looking for comparables. So the local tax administration is equipped with guidance, but I'm sure we'll use it sensibly. I think we'll have to go on to the next slide now. Yes, please. Thanks very much. Another thing that our article was concerned about is withholding tax, because this is, from a tax administration's point of view, a very efficient way of collecting tax. For one thing, that you make the taxpayer do the work. The taxpayer is deducting the tax and remitting it to the tax administration, which from their point of view reduces their compliance costs, but slightly increases the taxpayers, of course. So they will see it as a good way to, perhaps a good way to approach collecting tax at an early stage, collecting tax which they consider is due to them on cross-border transactions, especially. And we'd be looking at royalties, interest, technical service fees. We'll have more to say about that a bit later. And again, because supply chains are being reorganized and these payments will be perhaps being made from new locations, that could mean potential problems that will need to be looked at in advance by multinationals where they're reorganizing their supply chains. So that definitely means a review of cross-border payments is always going to be necessary. So there are some disadvantages of withholding tax for the tax administration, and again there's this problem of potentially discouraging foreign investment by lumping too much withholding tax, requiring too much withholding tax to be locked off in the source jurisdiction before payment goes back to the home jurisdiction. So that's a potential problem. There's also the problem of using withholding taxes as too much of a blunt instrument, especially if the income category is not well defined. So the multinationals should look out for this, that how is the income category for withholding tax defined in the local law? And then we have the problem of interaction of the local law with the double tax treaty, which is also a potential problem. You think you're going to be entitled to a reduction under the tax treaty, but it may be that you're outside the definition in the treaty and you're still caught by the local law. It's a possibility if the definitions don't overlap. So that's also something that would need to be looked out for. Hafiz, should we be taking any of those questions now? Is that a good time, or should we?
No, I think, Bob, we wanted to do the questions at the end.
Okay, we'll leave them.
I'm conscious of time. We were supposed to finish around now with the presentation.
Okay. Right.
So perhaps, Peter, we can just, Dana, we can move to the next slide, please.
Yeah.
Perhaps we can just kind of run through this because I suspect that pretty much everybody here is bored to death with all the Pillar 2, Pillar 1 stuff and has heard enough of it. All we wanted to say is, I mean, there's no need to go into the detail of it. It's already there in the article. And since the article, the OECD has come out with some more publications and reports on it. The one thing that I would want to mention is what was described last month in an OECD presentation around the potential revenue impact, the economic impact of this, and that was these huge numbers that they've come up with, that the combined effect of pillars 1 and 2, along with the US guilty provisions, could be a total revenue increase to governments of somewhere in the order of $60 to $100 billion a year in corporate income tax. And that is, again, real money. By anybody's book. I know in Washington, 100 billion now in this deficit age doesn't sound too much, but that is real money by anybody's book. And I am just concerned that this is creating false expectations, just like that other 100 billion figure I mentioned. If you go into the detail, you find out that the OECD itself is saying that the net impact of Pillar 1, the whole digitalization part, is more a reallocation than actual revenue increase. What they're saying is that Pillar 2, this idea of a global minimum tax standard, will somehow push revenue out of low tax investment hubs into full tax regimes. And I am personally not convinced that that is actually going to come true. The combined administrative cost, and that's why we've put the words economic impact into this slide, the massive compliance cost around the digital economy proposals, along with the investment dampening effects that might come from this degree of compliance requirements, to my mind, has not yet been really examined, and that's something that I would, to the extent that there are any policymakers listening in, I would suggest that, and that is certainly a position that ITIC has taken. On the private sector side, all we can say is that that's something that governments, that companies should be aware of as to what's going to happen, because the impact of this Pillar 1, Pillar 2 approach, especially this market allocation, is a lot wider than just digital companies. It's going to affect fast-moving consumer goods. Anybody with a significant market footprint is going to be affected. Next slide, please. And I promise we're coming to an end. So here's the tax policy after the crisis. So it's not possible to make, I don't think I'm qualified to make these kind of global recommendations, but in terms of the policy advice that ITIC certainly is making, is to say, whatever tax policy you take after the crisis has to be aware of economic growth, as the requirements of economic growth, and private investment capital as a driver of economic growth for the recovery. On the application and administration side, why not look at existing documentation, existing information? So for example, for extractive companies, oil and gas prices are public record. They are openly quoted numbers. For example, there are intercompany arrangements that are, for example, like consortium arrangements where information is readily available. Also to look at risk assessment. What does this policy measure you're considering do versus what risks it carries in terms of risks to foreign investment, in risk to your existing taxpayer base, before you go out and try and look at other things. So look at in terms of comparable companies and transactions, just to use a specific example. While there's extensive guidance in financial transactions, as Peter has said in the new UN manual, as well as the OECD Chapter 10, why not look at just cups that are out there, such as published interest rates or interbank rates? In many developing countries, and I've faced that with client relationships, developing countries have standard rules for foreign debt, yet the domestic interest market is very different. Why have inconsistent treatment? Allow open market information that is readily available to be used, rather than complex transfer pricing rules. Next slide, please. And I think this is the last one. So we recognize, I think from an ITSC standpoint, it is recognized that countries will need to collect more tax. And this is something that multinationals will also have to recognize. But the important thing is in order to have the most efficient economic outcome, especially in these conditions of this global economic crisis, is that you need to target the low-hanging fruit more effectively, try and enforce what laws you already have in place rather than bringing in a lot of new regulations. From a government standpoint, there is naturally going to be closer inspection, examination of business restructurings. So from the private sector standpoint, you really should be conscious of that. And from a government viewpoint, withholding tax will be seen as an efficient way to collect taxes, but we should be careful that it doesn't be too much of a blunt instrument. And finally, last thought, on the digital economy, while this is being presented as this big panacea to all our problems, the signs are that it is not as much of a solution as governments are thinking. So those are kind of takeaways that I thought we could share. And we are open for questions. And I know we have some questions already, Bob.
Yes, we do. And thank you, gentlemen. That was those are some excellent insights. Again, it's a brilliant paper. If you haven't read it, you absolutely should. So questions, we've got a couple here. First one, let's see, it says, in your article, you state that, quote, a management fee is a charge imposed for the management or administrative services of a foreign parent company or head office. Such fees have often been seen by tax administrations as a vehicle used by multinationals to shift profits out of a jurisdiction. The question, is there any publicly available data supporting this notion that multinationals use management or administrative services for profit shifting? What does the data actually say?
And that, I think the questioner has hit it on the head. There isn't much in the way of publicly available data. There has been some tax cases, noticeably in India. I believe there has been a case or two. There was a case in Indonesia where examples of this type have come about. But to the extent that, certainly in my experience, governments have been using this, it has been something akin to the secret comparables problems that we saw being used in Japan and Korea, maybe going 20, 25 years ago. So it's that sort of issue, but that is not to say, and especially I would ask people to go and look at that UNCTAD report. There are very good kind of macro conclusions being drawn. I wouldn't say good, I should take that back. It's not good necessarily, but there are very broad macro conclusions being drawn, whereas there does not seem to be enough substantive data to support those conclusions.
Mm-hmm. Excellent point. Second question. Follow up in the sense that it also gets to management and administrative services. You say in the article that a simple approach is to impose a withholding tax on management fees and possibly make the income tax deduction for the payment of that fees dependent on the correct withholding tax being collected and remitted, basically making the deduction contingent on the withholding. Now, the question is, most tax treaties generally consider these services to fit under Article 7 of the model, business profits, meaning they're not really taxable at source, the way we have the orientation of these things, at least not unless the service provider has a permanent establishment in the country in question. So, and this view is consistent with the OECD model and the OECD commentaries. The question is, on what legal basis or framework do you consider that countries should start applying withholding taxes on those services?
So Peter, you were going to pick up this one?
Okay, I'll pick up this one, yeah. Well, first of all, yeah, I think the questioner is absolutely correct. Yes, these would be a part of business profits dealt with under the business profits article. And I think the article, it mentioned the word simple, a simple solution, but nothing is ever simple. I think it might be a solution then in certain limited circumstances where it's not covered under a treaty, that the withholding tax way could be, where it would be simple if it could be used, but it may be in rather limited circumstances that it could be used. I think what on this type of fee, what is perhaps more likely is that the tax administration might want to ask, is it something that has really been provided for the purposes of the business? In other words, is it some sort of disguised distribution, or is it or disguised shifting of profits, or is it actually something that relates to a real service that has been provided? And they might want to say, has it been correctly characterized? Even if a service has been provided, is it in fact correctly characterized? Is it a service that comes under Article 7, or could it come under one of the other articles of the treaty? So perhaps that way of looking at it.
Maybe I can come in on this one, Peter.
Yeah, certainly.
The other point that occurred to me when I saw that question was this entire analysis is being done from an OECD guidelines perspective, the OECD model and the OECD commentary. But I think that's part of what we're trying to stress here, that in the world of emerging and frontier markets where ITIC is most active, and most of these countries are by definition not OECD members, though they will look at the OECD commentary. what you do have now, and this is again perhaps something for this audience may not be aware, certainly some of my multinational clients are not always aware of this, is the new Article 12A in the UN Model Commentary about technical service fees, which creates a much more robust source rule for this sort of payment to have occurred in the developing country, and imposes a withholding tax obligation, an allocation and a withholding tax right. So I guess the takeaway is that while from a theoretical analysis, this is absolutely correct, the reality on the ground, especially the evolving reality in the ground going forward, as you look towards business restructurings and so forth, might be different as more countries adopt Article 12A.
Mm-hmm. All right. Our next question, I suppose it was inevitable that we'd be talking about the digital economy, even though the framing of the issue was more transfer pricing and withholding tax. How can you have a webinar on international taxation without the digital economy coming up? But the question, and I'll offer it to both of you, whoever wants to chime in, what are the fundamental issues that African countries must consider before going into the taxation of the digital economy?
I'll answer that because I'm closer to, Peter is working on a different project. So this is one that I'm actually working. I obviously can't mention the name of the country, but I literally have a call on this tomorrow with the client government. In Africa, the biggest issue in African countries is an administrative one. The capacity to collect the tax on the service is the fundamental problem. And where we are starting off from is a very differential problem across Africa. Some countries in Africa have gone down the inclusive framework route and have created a substantial economic presence test, or they've tried to create something like an unilateral equalization levy type of principle without even looking at the indirect tax side of the house, which is arguably slightly easier. I mean, it's not very easy either way, but the indirect tax aspect of it has not even been addressed. So consistency of treatment, legislation and administrative procedure, and finally administrative capacity. Those are the three, I think, takeaways that you need to have in place before you can move towards this. The other issue is that the majority of developing countries are looking at this as the usual suspects, Facebook and Apple and Google and all the big guys, and they are ignoring the much larger constituency of digital business that is ongoing, especially the small and medium-sized sector, which is not so small if you look at the consolidators who are using perhaps a service that will bring medicines to your front door, for example, and will source it from bricks and mortar shops. And this is quite common in Africa and Asia, that there are services that you go, it's effectively a Facebook page, but it brings the goods that you want from a bricks and mortar store, because that's the distribution chain, but is providing that service element, and that service element is not being taxable because currently there are no mechanisms in place. So I think it's a structure issue. To summarize, it's a structure issue, those 3 points I made earlier, and it's an environment, mapping that environment of the digital economy.
Mm-hmm. So much to think about when it comes to the digital economy. We could talk for a whole day about that without even getting to pillar 1 and pillar 2. So time for one final question, and then we'll wrap up. This is about the profit splits, because Peter hinted at that before, so this is maybe working around to it. Your article mentions the transfer pricing methodology, profit splits. It doesn't really rely on comparables so much. So the question is, how worried should we be that developing economies, as part of their chase for more tax revenue, will attempt to squeeze every transfer pricing dispute into the profit split box? Maybe for legitimate reasons, or perhaps because they just don't like the anticipated results if they did use the comparables that were available if they applied them. And secondarily, what can be done to discourage tax administrators from going down that path? I guess that's really all one question. Profit splits.
So we'd agreed also that I'd take this one. So I think the fundamental problem is that is one of information. There simply isn't enough comparable data, especially for unique transactions where maybe there's one multinational that is doing this. And this is more a problem for medium-sized developing countries, medium-sized upper middle income developing countries, or lower middle income developing countries. Because what you're seeing are transactions. This is the real world. You're seeing a transaction in a country that is, let's say, per capita income of around $3,000 to $5,000. So there isn't enough scale in the market for more than one player in a particular economic segment. So there simply isn't enough comparables unless we endorse secret comparables. So profit splits then become kind of a go-to approach to the extent, and this is very much a middle income country problem. Typically, less developed countries, LDCs as they are called, and lower income countries don't have the transfer pricing capacity to get into this area. But what I have certainly seen in middle income countries is that this becomes a problem when they even if they try to apply a traditional method, try and look for a cap, it just is not present. So the choice is to use other data, make adjustments, and make it to treat it as comparable, or a simpler approach is go towards a profit split. Now, the second part of the question, what can be done? Again, sorry to end this with a plug for the UN manual, but the UN manual does provide developing countries with mechanisms and approaches to use third country comparable data and make the adjustments to make it comparable and use it. That expertise is not there. ITIC is doing some work along those lines, and the UN is doing a lot of capacity building work. As capacity develops, I think that sort of practice will emerge, but from the multinational side, that's what I always tell my MNC clients, that you just have to deal with the reality that even with the best will in the world, the tax administration on the other side of the table does not have the ability to use comparables because of where they are today. So with that kind of
that's a reality.
Maybe not a very clear direction, but with some hope. Maybe that's the point at which we end today.
Okay. And it is time to end. Thank you, everyone, for your attention. I especially want to thank the good folks at ITIC for their considerable expertise in compiling all of these papers that Tax Notes International is so pleased to be able to publish. And of course, thanks to the many authors who produced those materials. A quick reminder that you can catch all of these webinars in this series on the Tax Notes YouTube channel. And if you're a reader of Tax Notes International, keep your eyes open for future installments. Hafiz, Peter, thank you so much. It's been a very informative discussion. Look forward to doing this again soon.
Thank you. Thank you, everybody. Bye-bye.
Thanks. Bye.